Welcome. It's autumn 2010 and across Australia our housing markets have done remarkably well. Houses grew for the first quarter by 1.97% and for the year 9.8%. The unit market performed more strongly, and this stronger performance is something that we're going to see more often as we move forward in the future, and is something that we'll speak more of in this video. The performance was 3.57% for the quarter and 10.3% for the full year. Our strongest capital city was Melbourne, with a median value today of $562,500. Its quarterly growth was 3.55%, and its yearly growth to the end of March was 17.5%, a very strong outcome. The Sydney market performed less strongly, but still quite respectably. Houses had a median value of $641,000 and a growth for the quarter of 1.38%. A total yearly growth of 13.49, a spectacular outcome when you consider that most commentators other than Residex were in the market predicting a fall in the housing market for the current year. Brisbane, the poor cousin. Its median value today is $461,000, and it is the only capital city in anywhere in Australia where values fell back slightly. For the quarter they fell by 2.24%, and for the year we had a growth rate which was positive of 4.94%. The unit market performed more strongly again. We had a growth of 1.39%, and for the year the units turned in a total rate of return of 6.18%. Perth has turned the corner, and its median value today is $486,500. However, at this median price, it is still out of kilter in terms of its long-term position relative to the other values of other capital cities. Its quarterly rate of growth was slightly positive at 0.27%, and its yearly rate of growth was 5.23%. Overall, I suspect that we'll have a little while to wait yet before Perth turns in what I'll call long-term respectable rates of growth. So when we look at all of the median numbers and we consider them, it's quite clear that all of the press should be very positive. However, there is a hidden problem within the numbers. The middle of the market is actually growing very well, and hence these numbers, which are median numbers or the middle of the market results, are showing us that the market is doing very well. However, the tails of the distribution or the lower cost areas of our capital cities are not doing so well at all. If we look at Brisbane, for example, what we will find is that 53% of all suburbs in that capital city fell in value. And of that 53%, 83% were in fact suburbs that had a median value of less than the actual Brisbane median value. So what we are saying is that Mr. and Mrs. Average, or slightly less than average in Brisbane, are suffering, and the values or their wealth is slightly falling. In Sydney, 20% of all of the suburbs fell in value, and again, nearly every one of those suburbs fitted into the lower socio-economic areas. These lower socio-economic areas are clearly stressed, and they are stressed by the increasing interest rates that the Reserve Bank is implementing. We can see the level of stress when we consider their take-home after-tax pay in terms of what it would take to make a mortgage repayment for the typical house. They would use up approximately 62% of that take-home pay to make their repayment in both Melbourne and in Sydney. To put this in perspective, in Sydney they would have $505 a week having made that repayment to live, to buy food, to buy clothes, to fuel the car and make the repayments on their car and provide the other necessities of life. So clearly, as we move forward, the Reserve Bank needs to be particularly careful as it increases interest rates. And, in my view, it would be better at the current situation if in fact they held back for a little longer. This affordability is an important issue, as it has a direct bearing on what we should be doing as we invest in our housing markets in the future. The unit market currently is some 20% more affordable than the housing market in those two major capital cities. The consequence of that is that as these two cities become so unaffordable that the majority can't in fact actually access a home, they will be driven to the unit market. One other thing, the unit market is in fact the investor's domain. It is the market which most benefits as investors re-enter the market. As a consequence of this, we can expect the unit market to grow more strongly than the housing market, and that has been evident in the numbers that I've shown you today. So how are you going to identify those suburbs for units which are going to do best over the medium to long term? Well, the easiest way is to spend as little as $90 and buy the Residex report. That report contains a full listing of every suburb in the state, and at the same time provides its median rate of growth, its rental yield and its historical rates of capital growth. Remember, history does point to the future to some extent. It's the only guide that we've got. And if you're not inclined to do your own homework like this, then go and have a look at our website and get our top 100 predictions or the best rent report. In each of my video presentations, I endeavour to provide a little further information about the way in which the housing market performs. Clearly, the information that I've provided today on unaffordability must make you wonder about the risks. It's my view that if you continue to invest in the unit market in the right area and in the right price bracket, then the risks are acceptable and the returns in total terms are likely to be very good. Remember that there is a strong correlation between rental return and house price growth. So when one is low, the other is high. And in this particular scenario, we can expect that rental yields will rise and housing price growth will be slightly lower than we've seen in the past. However, in the unit market where it is highly affordable and in well-positioned sections, then we can expect very good rates of growth and high rates of rental return. So overall, the returns are likely to be very good. If you look at the long-term position as presented in this graph, you can see that in the bottom right-hand corner, we've got housing, which is the best investment you could have. It's low risk with a high level of real return. The y-axis represents the risk of the houses failing to keep pace with inflation, and the x, the after inflation return or the real return. In conclusion, I would say it is time to seriously look at investing in the Sydney unit market, in those areas which are affordable and in those areas which are really close to transport. I would be cautious about the Melbourne market, particularly given its recent high rates of growth. It might be very close to the top. There may not be a lot of growth left. So good luck, and I look forward to speaking to you next time.